Hello everyone, thanks for tuning in. So in today's session, I get to explain the concept behind the provisional income tax. Let me start it this way. Every day, businesses are opened and then they start operating. Of course, when businesses are open, they start operating, they are making transactions and all these things. At the end of the day, the businessman seeks to make a profit out of the activities of his business. Now, in an ideal world, this is how it's supposed to be. You're going to take a whole year doing business. After you're done with doing business after the year, then in other words, after the year of income is done or the 12 months, you're going to invite external auditors. They're going to audit your books, prepare financial statements, which are basically, write-ups telling a story about how your business has been. And a profit or a loss is going to be declared. If a loss is declared, there is no tax to pay. If a profit is declared, it means government needs a portion of that profit for developing the country. In Uganda's case, if you make a profit, government will want 30% of that as corporate income tax. As I'm making this video, that is the rate for people who make profit in business. When you make a profit, 30% of that profit is income tax. So it's basically supposed to be that you're supposed to first run your activities, make the profit, then after making the profit, then declare the profit and then scoop 30% of that profit and pay to government in terms of tax or in form of tax. That is how it is supposed to be. But because, government will not wait for you to first make the money and then declare the profit. They won't wait for you. So instead of waiting for you, they now require you to predict. Yes, let's say your year of income is running from 1st January to 31st December. So instead of first completing the whole year so that you get the profit to give to government, instead government requires you to sit down and predict. Look at your past performance, look at your projections and predict how much profit do you think you will make, and out of that profit, how much tax do you think you will be able to pay? So after making those predictions, you can base it on your gut, you can base it on your past performance, you can base it on some metrics, whatever formula you use. Just make a prediction. When you make the prediction that, okay, I think by the end of this year, I will make profit of 100 million. Out of 100 million, 30% of that profit is 30 million. That is the tax. So government requires you to get that 30 million and pay it during the year. So when you pay that money during the year, then you continue to be doing business. After the end of the cycle or the end of the year of income, after the end of the 12 months, then you can now declare your income tax return, which we call the final income tax return. And now the tax liability that you paid during the year of income is now the one that you're now going to declare in your final income tax return. So in other words, in your final income tax return, as you're declaring the information about the affairs of your business throughout the year, the tax liability that is arising out of the final income tax return is actually a liability that you had already paid for in advance. So that declaration of that tax ahead of time is what we are calling provisional income tax. So when you're filing provisional income tax, you're actually declaring or you're paying income tax liability in advance. That is why in our previous videos we said that when we are providing for income tax, you can only provide during the year. And that is why in case you need to amend your provisional income tax estimate, you can only amend during the year of income. After that year of income is done, the system actually won't even allow you to amend. In other words, you cannot provide for income tax in a year that you're not in. So basically, this is the theory or the idea behind provisional income tax. Provisional income tax, you are supposed to be, for non-individuals, like I mentioned in the previous video, you're supposed to declare your provisional income tax return within the first 6 months of the year of income you're in. For individuals, you are supposed to declare your provisional income tax return within the first 3 months of the year of income you are in. And when you declare that money, when you pay that money, it is more like you're paying income tax in advance. So that when the year of income gets done, and now you start filing your final income tax return, as you're filing that final income tax return, you're actually declaring a liability that you already paid for during the year via the mechanism of provisional income tax. This is the same with, in other words, this mechanism of, or this habit of government requiring citizens to pay their income tax in advance is not only in provisional income tax. The same is true even with your pay as you earn. Okay, when you are an employee and they deduct that pay as you earn from you every month. That pay as you earn is actually tax on your employment income. Ideally, you are supposed to first work for the whole year. After working for the whole year, then in your return, we declare all your employment income, how much you've been paid every month. Then the pay rates are applied to your annual salary. But, well, we are not going to wait for the whole year. Government is not going to wait for you to first work for the whole year. So what they do, they require your employer to deduct that money from you every month. When they deduct that money from you every month, it is tax credit. Okay, it's just that most people do not really, they do not have other sources of income. So it means that this money that is being deducted from you ends up being your final employment tax, because at the your final, it ends up being the same money you would pay if you had consolidated all your income for the whole year. That is if you're being paid for every month. Otherwise, if you are an individual and you have other sources of income besides your employment income, you are supposed to declare all your income sources. That is income from your employment, income from your maybe rentals, income from your business, and in that individual return, all those incomes are supposed to be accounted for in tax. I think we shall go deeper into that when we are covering income tax for an individual. Yeah. So what I'm trying to say here is that the income tax that you pay via pay as you earn is also income tax you're paying before, way ahead of time. It's tax credit. The same mechanism is employed even with the withholding tax mechanism. Okay, I am running a business, and as I am running a business, I am, I have these people that give me these services. Okay, I have suppliers who give me stuff and all these things. If I am a withholding tax agent, it means that when I am paying them, I withhold 6% of their money and submit it to URA. That 6%, or I'm saying 6% because it's the withholding tax rate or the prevailing tax law as I am speaking for supplies, but it could be any percentage depending on the tax law. So when I withhold that money from my suppliers as I'm paying them, I am withholding part of that money and I am paying it to URA on their behalf. When I pay to URA on their behalf, that money is their tax credit, and they are waiting that tax credit is waiting to be offset against their tax liability when they eventually declare their final income tax return. So this is just, I'm just bringing up examples here to show that this idea of making people pay income tax in advance It's not just with provisional income tax return mechanism. The scheme is also with pay as you earn. The scheme is also employed with withholding tax. The scheme is also employed with advanced income tax. Those guys who, drive taxis, or who are driving these big lorries, commercial vehicles, they are required to pay what we call advanced income tax. The advanced income tax rate varies depending on what the people in the transport sector, depending on what you're doing, what kind of work you're doing. Are you carrying passengers? Are you carrying commercial goods? What is the capacity of the commercial good? What's the kind of truck? So the advanced income tax you pay, for example, currently as I'm making these videos for taxis, I think it's 20,000 per seat. So if it is a 14-seater taxi, it is 280 for a whole year. So they pay that money, but that money is claimable. You're paying income tax in advance. So at the end of the year, if maybe it's a business person and they decide to prepare financial statements, they get to create a liability, and that liability can be offset against those tax credits. Only that, in practice, a lot of these taxi people do not really care for doing those financial statements and claiming their tax credit and all those things. So it ends up being final tax by URA. Why do we say this? Because our Income Tax Act says that income tax is imposed for a year of income. It's imposed on a person. This person must have earned chargeable income, and that chargeable income is supposed to have been derived during a year of income. Okay, that's why this monthly pay as you earn, it is just a mechanism to get taxes ahead of time. Okay, ahead before the year ends, that kind of thing. So again, okay, I have spilled over into um, giving other examples on how this idea of collecting taxes in advance works, but the main purpose of this video was to explain the concept behind provisional. So with provisional income tax, that is how it is. You pay it ahead of time. When you pay it ahead of time, it is waiting to be offset against the final tax liability that you will declare in your final income tax return. So when that happens, um, uh, ideally, by the way, in this provisional income tax estimate, you are expected to declare 100%. So you if you're going to make a profit of 100 million, and the profit 30% of 100 million is 30 million, so 30 million is the income tax. So if 30 million is the income tax you expect to pay at the end of the period, they expect that your predictions have to be 100% accurate. But of course, sometimes the business environment is not predictable. And because the business environment is not predictable, you will find that you might not predict correctly. So, in the event that you do not predict correctly, you're given an allowance of 10%. So, if in and that allowance of 10% is determined when you eventually file your final income tax return after the 12 months period. Let me give an example. Let's say during the year, you predicted that you're going to make, in all your calculations and all your forecasts and whatever, you said, I think I'll pay 1 million in taxes. And then after the year ends, you file your income tax return, the final, and it's indeed 1 million that you file in your final. So yes, provisional, you provided 1 million. In your final, it's 1 million. Then it means for you, your provisional estimate was 100%. You predicted correctly that you're going to pay 1 million shillings as your tax. Now, it's not always going to be that you will predict accurately like that. So if, let's say, I predicted that I provided 1 million during the provisional filing, and then final income tax return, I I find myself, declaring a final income tax liability of like 500,000. I provided for 1 million, then I paid 500,000. That means that I over provided. I paid 1 million during the course of the year as provisional income tax, but the final I paid 500,000 as the final liability. So that over provision, the balance remains on your ledger as a tax credit, and it can be carried forward to the next year for it to be offset against future income tax liabilities. Now, in the event that, let's say, it's the other way around, you declared 100,000 during provisional income tax, and then in the final income tax return, you file and you declare 1 million. Okay, so during the year, you only provided for 100,000 and you paid 100,000. Then at the end of the year, instead you declared 1 million as a tax liability. That means that you under provided, and there are penalties for under provision of provisional income tax. You're not allowed, it is not cool for you to under provide. There are penalties for under provision. So the margin of error that is acceptable here is 10%. This simply means that if you are not able to predict correctly what your final income tax liability is going to be, at least do not go below 90%. So that means that if your final income tax liability is going to be 1 million, your provisional income tax declared should not go below 900,000. That is what I mean by it should not be below 90%. In other words, your final income tax liability should not be, what you provided for should not be below 90% of your final income tax liability. If it goes below 90%, there is a penalty for understating provisional income tax. So that's it. Thank you for watching. My name is Arnold Kisembo, and this is Kisembo Business.